or do something different. Okay, so tax considerations might be the other thing. All right, so default risk. Let's get a definition going for that. So it is the probability that the issuer, which is government or business, right? The issuer of the bond, is unable or unwilling to make interest payments, or the coupon payments, interest payments, or the face value, or pay off face value. So, a couple important notes. How many times has the United States government only defaulted on their bonds? Never. So, then in that respect, U.S. Treasury bonds are considered default-free. Are considered default-free, or let's say to have, let me just put, to have default-free risk. Default-free risk. So when we start pricing things, risk costs money, right? If you are more risky, then it's going to cost you more. You're going to have to pay more of an interest rate. Since the government has been good so far, decent track record. By the way, are all governments good by the U.S.? No. Perceptions over time were certainly that governments were solid, but places like Greece and Spain and other places around Europe and South America, we've come to learn that they are not default-free, so they have gone belly up. How about municipal bonds, like for cities and counties that need to raise some money for some stuff? Are you aware of any governments, local governments, that have had any issues? Are governments without risk? Local governments. So there was a bond issue, for instance, here in the city of Ottawa. The city of Ottawa is adding on to the high school and doing some other stuff, and they passed a $63 million bond issue. So they are literally borrowing from people like regular households and whatnot. They're going to the general market, and their ability to pay back will be graded by one of the bond rating agencies and sold to the market. And so we kind of use those bond rating agencies that hopefully they've done their homework and said, the city of Ottawa, you know, it's kind of a rough blue-collar crowd, but for the most part they pay the bills, and the city seems strong, and Ottawa University's there, and the local businesses seem to be doing okay, blah, 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 blah. And they come up with a risk factor of, is there something that would cause the city of Ottawa to not be able to pay back? More specifically, the school district is involved with that. But, so, is it possible? Have there been some defaults? Now giving you that picture. Right? So, what do you know about Detroit, Michigan? Struggling. How's the unemployment rate? High. Right? How are real estate values? Low. How do local government bonds pay back their stuff? With property taxes and people who live there that live in houses that pay those property taxes. So if that's not going on, I mean, there's just no way to do it. Of course, they could do what the federal government does. When they run out of money, what do? They borrow more money so that they can pay back the other money. Right? And so we kind of have this accumulation of debt over time. But for the city, it doesn't work that way because they're entering the private sector again and getting rated. By the way, the U.S. government would be rated by these agencies too. They're not immune to it. It's just that they have such a good track record that when these get put in the market, it's basically default free, but not true at the local level. All right. So U.S. Treasury bonds considered a fee. Not so true. Not true for local governments. Local government bond issues. And when I say local, it could be at the county level or the city level or state level for that matter. Something less than federal U.S. government. Okay, so that brings up what we call the risk premium. The risk premium. And that is the spread between the interest rate on bonds with default risk. And interest rates on the same maturity treasury bonds. So the spread between the interest rate on bonds with default risk and interest rates on the same maturity treasury bonds, which is what we noted up here. So the concept being, I'm an investor, I could go buy a US 10-year treasury bond, or I could put it into GM and buy a GM bonds, that stock. If I look at the 10-year rate on the US Treasury and the 10-year rate on the GM, GM's paying 10%, the government's paying 6%, then we got a 4% spread. What's making up that difference? Default risk. Right? So that's we call that the risk premium on that amount. So let's see, I think I will just jump into this little picture here. Well, maybe I won't jump into this picture. I forgot to plug in this picture thing, this little gizmo that gives me pictures. All right, so let's see, here we go. A little screen share screen. All right, here we go. And get you guys on the same one, we'll be in business here. HDMI, come on, technology, there we go. Okay, so we start off kind of equal with these two. So we've got corporate bonds, treasury bonds, the default-free treasury bonds. And if they were equal risk in the beginning, and then we change that as a top exercise that we're looking to do. So if we add some default risk to the corporate bonds, the demand for those bonds would fall. Right? All of the things equal, demand for those would fall, causing the price of bonds to fall, causes the interest rates to go up, right? price of bonds and interest rates inversely related. So as the price of bonds fall, the interest rates will be going up. By definition, that was part of how we looked at it, with the interest rate being the coupon payment, the actual payment for interest, divided by the price of the bond. So there's the inverse relationship. If the price of bonds goes down, this expression gets bigger, right? So those move in opposite directions, just a little hash from what we did last time with the negative relationship between interest rates and bonds. So price of bonds falls here, of course, everybody's wanting to get some of those good old US government bonds. So the demand goes up, the price goes up, and now that creates this interest rate differential. The effective yield on the Treasury would be going up. I'm sorry, it's inverse. The corporate bond is the higher rate, right? So this bond, the interest rate associated with it is actually higher. They don't show the scale here, but they could maybe do that differently, but that's how I would have done it. All right. Okay, questions? All right, next picture. Here are the ratings for bonds. Oops. I guess I can leave that there. I was trying to get this little picture to, I know I can get this guy out of the way here. There we go. Okay. So here is Moody's, the ratings and Fitch's. So these are 3 bond rating agencies, the ones that kind of cause some problems, as we'll learn later in some of the readings, especially in the financial crisis book. But this is what they look like. So AAA being the best, so that's our U.S. government bonds. And then we get a little bit of a AA with a minus, AA. Now, at what point do we get to junk bonds? What rating kind of looks like, according to the definition, it might be deserved to be called junk? BB plus. BB plus. Non-investment. So non-investment grade, right? So what is the rating agency telling you? Good luck. Yeah. Yeah, non-investment grade. Now you still, that's kind of misleading. Does that mean you should never buy it? No, right?
What kind of a business would that be? Or what kind of
a startup company that is just rolling the dice, or they don't have a proven track record of what they've been doing so far with the products. Even kind of a middle-sized company, leverage to the hilt or something, they might fall into that category. So portfolio managers will often, depending on what they're doing in hedge funds, they'll keep a fraction of their money into this junk bond world. Right? Substantial risk, extremely speculative, maybe already in default. Notice the rating we got here from this company? Forget it. I'm not even grading it. I don't think I have enough data, or I'm not going to spend the time to see if this is even worth it at all to compare it relative to these. So we've fallen into the really high risk category. Default, these ones, they are already in default. And we're still going to loan them more money, right? So what does it mean to be in default? What, Joe? Can't pay the coupon payment. Now, it might not be necessarily on, but you're right. Usually that would be that they haven't paid their coupon payment on some bonds already. Maybe not all of them, but on some of them. They could also be in default on some other things with the company. So they haven't paid their landlord rents and whatever. They're behind with their landlord. Maybe it's a retail chain. They might be default with some other things. They might be default on their mortgage if they purchase some assets. They might be default on a lease. So they leased a whole bunch of equipment from Dell. Their whole sales force had Dell computers, and they are in the tank to Dell to the tune of $100,000 this month. We look at their cash balances, and their cash balances are 110,000. Well, there's no way they can cut a check to Dell for the full payment, so they choose to say, sorry, we aren't making the payment. As soon as you don't make the payment timely, you are in a technical default. Now, it might not mean that Dell has canceled their lease, right? In fact, there might have been a phone call with Dell that said, hey, I know we're going to be in default. We're going to be a little late on our payment this month. I think we have a big deal, big contracts coming in 10 days from now. We'll get you covered then. Well, as soon as you don't make that payment, and if your document doesn't get amended, you are in a technical default with that person, whether it's a board or a lease obligation or any other sort of obligation. So the rating agencies are going to be paying special attention to all of those financial details associated with your company. All right, so yes, our junk bond category falls here. Again, that doesn't mean that it might not be something for you to buy. It's just kind of buyer beware. All right, questions on that? All right, let's see. Okay, yeah, I'll just do this with you guys can write this down. So the other two definitions, go ahead and just write those down real quick. Liquidity, the relative ease with which an asset can be converted to cash. It's kind of the most working definition of liquidity. I've seen some other things think about it as just your ability to turn one asset into another. But the idea is if you can convert something into cash, that buys pretty much anything you want. It pretty much says the income tax considerations of the other side. Okay, so I want to think about these bullets underneath the liquidity. Let me start with the last one first. Number of buyers and sellers in the bond market. What's that getting at? So it says the number. When does that reflect more liquidity? When there's a higher number or a lower number? Higher. Higher, right? So if we got lots of buyers and lots of sellers, no problem. You can jump into the market, check on the Wall Street Journal or your broker and see what something's trading at. You put it up for sale, it's sold. It's a no-brainer. Like the price is already determined. There's lots of buyers, lots of sellers. We watch the ticker tapes. The prices are going up and down. So as long as there's a large number of buyers and sellers, we don't have a problem. So when the financial crisis hits, that's when we can run into problems. If the market's tanking on a given day, there might be no buyers. Everybody's selling. Dump it, dump it, dump it, right? And so the price just keeps coming down, and we can't even find the bottom of the market. So during crisis and panic time, that market can kind of collapse, and it's not providing this liquidity feature. So we want a large number of buyers and sellers. That word large is kind of nebulous. That might depend on the marketplace. One of the things that made real estate interesting to me is that it's not a very liquid market, right? You don't expect, if you're going to put your house up for sale, when do you expect to have a buyer? Could be months, right? But you kind of are optimistically, well, gosh, in a couple of weeks we found a buyer, or 30 days we found a buyer, or within the next few months, whatever. But you automatically know that real estate's not very liquid, because at any given point in time, especially if we get into a smaller market like Ottawa, how many people are on the market looking for a house like mine? Even if the reasonable price would be $160,000 for it, how many people are going to be there ready to do that in our market on the day I list it? Well, we don't know. So we need to lengthen that marketing period. It might be more reasonable to think if I allow 30 days, there'll be some buyers that come into the market that will be able to do it. So it lengthens the amount of time between listing something for sale and actually realizing some cash in your hand. So there's less liquidity with that. Okay, so what about the cost of selling a bond? Higher cost or lower cost, what would lead to more liquidity? Lower cost. So if transactions costs are low, then that makes the thing more liquid. Real estate, another example. Is there low transaction costs? How do most people sell real estate and get into hit the most number of buyers? Yeah, you get a realtor, you might be paying 5 to 7% real easily in most markets to hire a professional to handle that transaction. Then there's going to be a few little bit more closing costs on top of that. So if there's relatively low transaction costs, then that's going to create a more liquid market. Okay, I want to do a little example with taxes here. Let's see, stop share. All right, so suppose we've got example with tax considerations. For tax on muni versus other, maybe a corporate bond. So suppose that the price of the bond is $1,000 with a coupon payment of $80. Whereas another bond that's going to have some tax consideration to it is $1,000 with a coupon payment of $100. If the tax rate T is 30%, what is the impact on after-tax yield? So let's take a minute. I'd like to say, I'm going to walk around the room. You guys can work on that one. What is the after-tax yield? We've got a municipal bond is the one with the M. So you've got a $1,000 bond with an $80 coupon payment. Let's just say it's a one-year bond, one-year deal. And you've got $1,000 in another one. The coupon payment's higher, it's 10%. What is the after-tax rate of return for each? That is the interest rate of return. Oh, geez, put this water down. Oh, wow, that turns out backwards for you guys. Interesting. Oops, oh well. Hey, if it's broke, just leave it. It's not going to get any more unbroke by picking it up. It's my philosophy. All right, so first of all, municipal bond. Tax-free. What is the rate of return for it? $80 coupon payment, $1,000 one-year deal. Simple. I'm not trying to trick you with any big present value stuff. 8%. All right. So that one's 8% for the municipal bond. And so what are you going to get socked with? What's your after-tax return for the other? 7. All right. So that's kind of the lesson here with taxes. The after-tax formula
Where was the 7 from? Again, I'm sorry.
I'll come to it. I'll come back to it. Yeah, that's for the after tax. I'm going to work it out for you here. But so the after tax return, so the interest rate for instrument T after tax, I'm not trying to be too cutesy with this, but you get your interest rate minus your tax rate times your interest rate. Some of you did this in your head. But let's kind of think about what it was.
I'm sorry, can you explain what all those mean again?
Yep, I will. So we're trying to calculate what the after-tax effect is for the one that has tax consideration. I'll come back to the muni one here. I mean, this one is just, I get 80 bucks, $1,000, 80 divided by 1,000 equals 8%, right? So the interest rate for the, the municipal bond is equal to 80 divided by 1,000 gives me 8%. And then there's no taxes, so no big deal. So after tax, when I do have taxes here, is I've got the before tax rate, which is my, how much for this one? 10%. And that's just 100 divided by the 1,000. So if there was no taxes, I would be making 10% on my money. Now, I'm going to get the $100 as income, and the income tax is 30%. So you can kind of think about that using the numbers here. 100 times 30 is $30 worth of tax, right? But we can also think about it being the interest rate times the tax. So I got the 30%, I'm going to do 0.30, the tax rate, times the interest rate here of 10%. It would also be 100 if we thought about it that way. So now we got 100 minus 30 equals 70. Or if we stay in the interest rate world, we can look at it as 10% times 1 minus 30%. Now, I know most of you probably didn't do it this way, but I'm showing it to you for a reason, because sometimes we express it that way with interest rates. So I kind of wanted to take you through that logic first, because it's common to write the nominal rate times 1 minus t. And that gives you the after-tax rate. So we could have before tax and after tax. So the interest rate after tax is the interest rate times 1 minus t. So you're going to get 70% of it. Once we see it on paper, it's not too bad if we work through that. So up here, if we kind of just work it through the way we were thinking, I'm going to get my payment. I've got the 7%, the 10% interest rate. So the interest rate was the 100 over 1,000 equals the 10%. But now I've got the tax to pay on the income of $100 or the rate of 10%. So I've got a tax equal to 30% times the $100 payment equals $30. So my real payment, I'm getting kind of over to the side here. So my after-tax coupon payment, so the coupon payment after tax is simply 100 minus 30 equals 70. That's another way to think about it. So I get the after-tax interest rate of 70 over 100. I'm sorry. That's the, that's right, 7%. So I kind of did two different ways. It doesn't really matter which way you do it. Okay, so questions?
Oh, would it be 70 over 1,000?
70 over 1,000, yes. All right, so that tax rate is dependent on what? Some of you have had some advanced accounting classes. This is what makes the bond market kind of interesting. I'm looking at Chisholm, and who else is advanced accounting? Tag and Zach, a little bit. Okay, all right. So, what would drive the tax rate? What would drive this assumption? In other words, does this apply to every American? Where am I here? T, right here. What determines that? What kind of business you are, process, level of income, right? So where are you at income-wise? So if you're a high-income earner, if you're making $200,000 a year, you might fall into that 30-plus tax bracket, probably higher, 35 or so. But if you're little old grandma thinking about your retirement, and you're only making off of your retirement income, I don't know, $40,000 a year, what tax bracket might you fall into? Maybe 10% or something. I don't know. So let's just call it 10 for fun. But you see how that drives the result here, that grandma might be better off doing the after-tax one. Because after you pay the tax, if you're at a 10% rate, then your rate's going to be 9% after tax compared to the tax-free municipal bond that's at 8%. Right? So this is, again, situational depending on the investor. That's why we have investment advisors. Then they're going to figure in, okay, where are you guys at with your, what kind of business is it? Where's your income? What's the right thing? What's the timing? How old are you? You know, whatever. All those circumstances will lead you to the right answer. It's not a one-size-fits-all. That's part of what wealth management is about. Okay, any last things there? All right, so this gives us perfect time to look at get into the yield curves. At least a little, we'll get a little bit exposed to it here. Okay, so here's a quick little graph, as long as it's up here, on interest rates on municipal bonds. Are we going to expect them to be higher or lower? So municipal bonds, the demand would be higher, price would go up, interest rates down. So we get this interest rate differential caused by tax considerations. But like I said, it also is going to have some default risk on it too. So the yield curve concept deals with the term structure of interest rates. Bonds with identical risk, identical liquidity, and identical tax characteristics may have different interest rates because the time remaining to maturity is different. Right? So now we're really honing in. We're going to hold constant all of those other things, and we're going to say, what would it look like if we had a longer term? And so this was the risk that I think was brought up earlier on holding it longer is going to be a little more risky because it might add some default risk. All right, so the yield curve, a plot of yields on bonds with everything the same except maturity. Go ahead and write this down in your notes, the yield curve definition. All right, so what would we expect the yield curve to look like? What is your gut telling you? Would it be A, B, or C? What would a yield curve look like if we plotted that? So the plot we're thinking about has maturity here, right? And interest rates, yields here. Would it be for the 1, the 2, the 3, the 4, the 5, the 6, 7, 8, 9, 10-year maturity, holding constant differing maturities, but the same risk, same liquidity, same tax considerations? Would you expect it to be A, B, or C? A, right, is what we were kind of our gut feeling was. So we kind of expect a longer period of time to lead to some higher, more risk, more return required. So A is the most normal case. And some things have to be going on to get some of those other looks. And so here's some facts. You don't have to write these down at this point. We're fine. I'm going to show you the real yield curve here in a second. So interest rates on bonds of different maturities move together over time. Interest rates of bonds of different maturities move together. One goes up, the other goes up, right? One goes down, the other goes down. When short-term interest rates are low, yield curves are most likely to have an upward slope. When short-term rates are high, yield curves tend to be more likely to look like C. So C is still a possibility. That's what we've observed in the data over time. When short-term rates are high, they might be inverted. Yield curves almost always slope upward. All right, so I pulled the Wall Street Journal here. This is actual data from, well, it should be live actually. I'll try to make this a little bit bigger. All right, so there's our yield curve. And this is on the 10-year. This is the up to the 10-year. It's got the full range of maturities. And so we scale over this and look at the U.S. Treasury note today and 1 year ago. And that was the difference. So we have a normal looking yield curve, first of all, going on today in today's market. Yes. So these are all today's prices on a 3-month Treasury bill. 3-month Treasury bill. A good place to put your money? Only if you want to earn 0.18. So that's like 51% or 5.8% if we annualize that, or how much is that? 0.5. So if you put $100 of your hard-earned money into a 3-month Treasury bill, if you loan the U.S. government $100, how much do you get back? 50 cents. 1% would be $1. You've earned 50 cents. You give up $100 for 1 year. Right? You give that to the government. If it's 1 month, it's even a little bit worse. It's pretty much flat, I guess, between the 1 month. 6 months, woohoo! We're up to 60 cents for that $100 investment. 80 cents. Give up my money for 2 years. Right? So I'm going to give my money up for 2 years. I'm going to give $100 up for 2 years. How much money 2 years from now? That's like 2019, right? How much is the government going to cut me back? How much more? I'm going to get 100 plus $1.19. Wow, that's generous, huh? Wow. Well, that's what it takes. And then check this out. I mean, this is almost equally as pathetic. 10 years from now, I get $2.37. Right? So this is what risk-free lending looks like. This is your alternative should be, should I stuff it in my mattress? Or should I give it to the U.S. government? And you better be darn sure you're not going to need it over the next 2 years. But that's what safety buys you, right? You give it to GM, like you're talking about, you invest it in the stock market. 2 years from now, your $100 might have turned into 80, right? So again, guaranteed money. That's the type of risk premium. You have to be willing to take a very small return. All right, we'll pick up there on Friday.